Welcome back, everyone. Michael here with Offshore Citizen. Today we're going to be responding a little bit to a question that one of our viewers had, which was all about the subject of how you optimize your tax as a digital nomad. So obviously in the world today, we've just gone through a year where suddenly location-independent work is much more possible than it was ever before, and it's just going to be a trend that's going to grow and grow. And so there's a lot of people who are going to be moving abroad. They're going to want to travel as they work, right? This particular person was saying they were going to be going to Bali and then going elsewhere. And so the questions are, okay, if you're in that situation, what do you do? So today I'm going to cover that for Americans, first of all, who are their whole own kettle of fish. And then for everybody else, give you a basic sense. Obviously, lots of the little details and nuances need to be fine-tuned as they apply to you. So we're going to get into that subject. And if you have any questions about it, you can reach out to me, which brings me to the next point, which is if you haven't already, please hit the subscribe button, hit the notification bell to make sure you don't miss out on any of our other videos. We try and put out good content every single day for you. Check out our website if you want to learn more about these subjects, which is offshorecitizen.net, offshorecapitalist.com. You can send us messages through there. And if you have at all interest in help with getting residency permits, learning more about digital nomad visas, second citizenships, including unofficial programs, citizenship by investment, etc., golden visas, international tax planning, so you've got a business and maybe you want to stay where you are, maybe you don't want to travel, but you want to optimize your tax. We want help with asset protection, banking, forming companies, etc. Please reach out to us. You can book a call with me, clarity.fm/Michael Rosmer. There's a link in the description below. Or again, you can send a message through either of our websites. Okay, let's dive into it. So I think the biggest point that we want to start with here is to separate Americans from everybody else. And why do I say that? Americans are the only ones who are taxed based on their citizenship, okay? Everybody else basically is taxed based on what we call their residency. And I've got some other videos you can check out about the difference between what residency means and so on and so forth. Okay, so I'm not going to cover that here, but that's an important subject to understand. And I was just talking to a client the other day who they were Australian and they were talking to somebody who was American, and there was like a disconnect because the American didn't understand that it's very different for Australians. So very, very important to know you're taxed based on your residency, okay? If you're an American, you're taxed based on your citizenship. So let's start quickly with Americans. For Americans, now, just because you're taxed in the US based on your citizenship does not mean that you're not going to be taxed somewhere else based on your residency. Okay, that's the first thing you need to know. In other words, if you go and you establish a home in some other country, let's just pick, for instance, Bali, okay, and you spend, more than half of the year there, you become tax resident there, well, then you're liable for Indonesian tax on top of US tax. Now, the US will give you tax credits for that, etc. But if you really want to optimize your tax, ideally you want to plan around that, right? You want to say, hey, listen, I'd rather not be taxable there, plus deal with my US. So I've done some videos about this in the past, and for Americans, the most basic thing that you can do, if you're willing to spend enough time out of the country, there's something called the bona fide residency test where you can actually be genuinely resident somewhere else and therefore qualify for this. It's called the foreign earned income exclusion, or you can spend 330 days out of the year outside of the US and also qualify for it. And if you're willing to do that, so you're going to spend a year of travel or 2 years of travel or something like that, you can get what is a little over $100,000 a year in earned income. So this is through what's called the foreign earned income exclusion. It doesn't count for investment income, potentially tax-free. Okay, so that's pretty awesome, right? You can say, okay, zero tax on that portion of your income. It's 100,000 inflation adjusted from a few years ago. So last I checked, it was like 107 and change. And there's a possibility to get this housing allowance as well. So you can potentially get a bit over that as tax-free income. Now, if you're over that point, we've talked a little bit about it before in some of our other videos, that there are some corporate structures you can use to maybe reduce your tax. And so that's also worth considering, right? Is saying, okay, if you're earning a higher amount of income, I would say that it has to be, just kind of think of it this way. You need to be in a situation where you make enough money that setting up a structure pays for itself, okay? And realistically, let's just say that that number to set up was $20,000, right? The reality is it could be less, it could be more, could be 5,000, it could be 65,000, depending on the complexity of what it is that you have going on. But let's just say it was 20,000. Well, if you're saying, okay, perfect, I'm already taking advantage of the foreign earned income exclusion, maybe I'm able to take advantage of the housing allowance, then, if you're making 150,000 or 160,000, it's probably not worth it, right? Because the differential on tax is not going to make sense there. If you're making 500,000, then maybe it does, right? If you're making $1 million, it almost certainly does. If you're making anything above that, it almost certainly does. So those are things that you can work out on a case by case. If you want help with that, reach out to us. Again, you can book a call with me and we can discuss your individual circumstances. But that's the first part, okay, is on the American side. Now, you need to worry about the second side. The second side applies to all these other people as well. So we're going to kind of cross over to everybody, all you guys, which is you don't want to become tax resident in a country that's going to tax you a bunch. So if at all possible, what does this start off with? Well, first of all, it starts off with definitely not spending more than 183 days in any country, okay? Pretty much across the board, there are some places where you can be tax-free, right? But most of the time, if you spend 183 days in a country, you're going to be taxable in that country. So if you're able to adjust your affairs such that you say, okay, I'm going to live here for a certain portion of the year, maybe I'm there for 2, 3, 4 months, then I'm going to go somewhere else, great. Then that potentially can be fairly clear. Now I'm going to get into some nuances in a minute of kind of where some complications there can come up, but let's just start with that. The number one thing, don't spend 183 days or more in any country, okay? That's good. Now, this comes to the other people, okay? All the people who are not Americans. So for the people who are not Americans, your actual most important first step is ceasing to be resident. So this is a big thing that I kind of run into where there's some misunderstandings for people, is that they confuse being resident for being non-resident. Okay, what does this mean? Just because you spending 183 days in a country makes you resident does not mean that spending less than 183 days makes you non-resident. Okay, and especially if that's your existing country. So this goes country by country. In some cases, it's very clear. Hey, listen, so long as you don't spend 183 days here, you're non-resident. In other cases, such as UK, they have the statutory residency test, and you can go through their flow chart and figure out what you have to do in order to kind of meet that standard. Okay. In other places, it gets a little bit more complex because in some of these places, such as Canada, such as Australia, etc., they really want you to have residency somewhere else. Okay, so they're going to try and claim residency over you unless you have residency in another place. So in this case, you have to set up your residency somewhere. This usually means getting a residency permit, right? And getting some sort of a long-term home. That's usually the keys. And the thing that goes along with that is ending your residency in your home country where you were before. Now the thing is, in practice, once you get out of their system, they're not going to be checking up every year, and you get some more flexibility provided you don't want to go back. Okay, if you want to go back, then that becomes a different matter. But usually, if you say, okay, great, I'm going to spend a year where I'm going to clean myself out of this system, which means that you're going to cut ties, okay? You're going to, if you have a home, you're either going to sell it or rent it out. You're probably going to get rid of a vehicle. Certainly if you have family, dependent family, they're going to come with you. Or if you're divorced or something, then it's a little bit different. Certainly those things that at the least you're going to want to separate out. Then you want to establish closer ties somewhere else than you do in your home country, if that's the case. Again, sometimes this is very easy, right? Again, this is very case by case. It depends country to country. So if you have questions about it, please reach out to me. It's not something that I can generalize across 196 countries, unfortunately. So I'm kind of giving you guys the basic idea. The important thing to remember here, end residency in your home country, okay? That way you're not in their tax net. Sometimes that means you can just cut ties and you can not spend so much time there. Perfect. Otherwise, you may have to get residency somewhere else. This is where we say, okay, well, where can we get residency that is going to optimize tax for us? We got a whole bunch of videos on that subject, so you can kind of go through. Again, I always say this really depends on where you want to live, not just based on where you can live. So sometimes it's Portugal, sometimes it's Cyprus, sometimes it's Thailand, sometimes it's Malaysia, sometimes it's Panama, sometimes it's Paraguay, it could be all over the place, UAE, bunch of places, but that needs to be decided for you. And by the way, maybe some people say, hey, listen, I'm willing to go someplace that I'm going to pay some tax. I don't need a place to pay zero tax, so long as it's a place that I like. Perfect, fantastic, great, go there. But there's a real opportunity to optimize your tax if you're in this situation where you're moving. Now, this brings us to our last point. What is our last point? Our last point is, technically speaking, under some countries' laws, if you're doing certain work inside that country, you could be subject to tax, even if you're not a resident there, okay? So do be aware of that. That can kind of catch you up a little bit. In practice, if you're not spending an extended period of time there, it's probably not a big issue because it's a really hard thing for them to catch and enforce, right? So if you're coming into a place for 3 months on a long-term tourist visa or something like that, maybe you get a digital nomad visa that allows you to stay 6 months or allows you to stay 12 months and you spend just under 6, right? Typically, you're going to be fine. You don't have too much to worry about. But do be aware that certainly in some countries, this is something that could trip you up. And definitely, if you're going to be spending a lot of time there, then that's a potential thing that could get you. So anyway, that's kind of the basics of what you need to do. So again, just to kind of quickly recap, if you're not American and residency in your foreign country, if possible, don't become resident anywhere else. That would be great. If you have to become resident somewhere else, do so in some place that is tax optimized. Likewise, if you're an American, if you can, take advantage of the foreign earned income exclusion, take advantage of the housing allowance, become resident either someplace where you can be tax optimized, or avoid being resident somewhere at all. And then from there you work out details that are very specific to you, right? Because they may depend on what kind of visas you have to get, where it is you want to be, what the local rules are, what the rules are where you came from, etc. And for all those things, you can reach out to us. So I hope that helps. If it does, please give it a thumbs up. If not, please tell me why in the comments. Would really love to hear from you. If you have specific questions, put them in the comments. If you haven't already, hit the subscribe button, hit the notification bell, and I'm going to look forward to seeing you guys on the next video.